After being down more than 1% on the day, shares of Intuit are down another 6.5% in the after hours on the heels of reporting their Q3 results. So is it time to invest in one of the most predictable companies that consistently outperforms the returns of the S&P 500, not just by a little bit, but actually by a significant margin, really over any time period, especially over the last 10 years? Now, as we answer that question, there's a few things to keep in mind. You're now looking at a company that's trading north of $180 billion in terms of its market cap and trading at a forward price to earnings multiple north of 40 times. So certainly Intuit was coming into this print with high expectations, and especially when you're trading near your 52-week highs and you don't come in and raise your guidance. In fact, you come in and post slightly disappointing guidance. Yeah, that is a recipe for disaster, at least for your stock price in the short term. Now, revenues for this most recent Q3 came in at $6.74 billion. That was good for 12% growth year over year. It did beat estimates on Wall Street by a small $100 million mark. On top of that, they came in with a beat on their non-GAAP EPS at $9.88. Again, a decent beat of right around 50 cents. So the first thing I want to highlight with Intuit is this is a company that posted $6.74 billion in revenue. This is for their Q3, so Intuit on a slightly different fiscal calendar, but I want to point out this is a company that tends to have the majority of their revenues and earnings come through in this quarter, considering this was their tax quarter, otherwise known as tax season, and the quarter ended in April. That's when your consumers and small businesses really across North America are filing their taxes, and this is your company behind TurboTax and QuickBooks, and so they recognize the majority of their revenues in their Q3. And so when you notice a steep decline in those Q4 and Q1 revenues, yeah, that's nothing to be surprised about. For Intuit, I would actually focus more so on the year-over-year growth rather than sequential numbers. And so we see year-over-year growth expectations were at 10.4%, Intuit coming in slightly higher, closer to 12%. On their consumer side, revenues came up roughly 9%. In terms of Credit Karma, another product that they own, revenues there were up 8%. And then on their Pro Tax group, revenues up just 3%. So as you look ahead to the next few quarters, look, this is one of your extremely predictable businesses, and revenues on their side are expected to grow in those low teens really over the next 4 to 5, even 6 quarters. Really, you paint a picture a couple years ahead and you're looking at, call it low teens growth on that revenue side into perpetuity. Now, in terms of the EPS they posted, that was once again a beat, as expectations were for $9.38, Intuit coming in with $9.88. In fact, the high end for estimates on Wall Street were for $9.58. So Intuit coming in higher than your expectations, at least on the earnings side. Now, where they did disappoint was for the guidance in the current Q4 that we are in. Intuit is guiding for non-GAAP EPS somewhere between 180 up to 185. Expectations were closer to 192. That's on the midpoint. You had some high-end estimates for Intuit north of $2 in terms of earnings per share for the current Q4. And certainly when you have a company trading north of 40 times, you have high expectations. And when you don't come in and at least even match those expectations, you will see a decline in your stock price. Now, where Intuit did surprise to the upside is on their full year 2024 outlook. And so we know they have just one quarter remaining in their fiscal 2024. And despite coming in with a lower guide on your Q4 EPS, they did raise their revenue guidance for the full year of 2024 up to $16.16 to $16.2 billion. The consensus was for $16.05 billion. And so now Intuit expecting their full year revenues to be up somewhere around 13%. The previous guide was for somewhere between 11 to 12%. On top of that, they're also raising their full year non-GAAP operating income, now expected to grow roughly 16%. Previous guide was between 12 to 14%. And lastly, their non-GAAP diluted EPS expected to come in somewhere around $16.80. Previous consensus estimates were for $16.42. And so Intuit expecting their EPS to grow roughly 17%. The previous guide was for somewhere between 12 to 14%. So as we look ahead the next couple of years for this company on their EPS, they're expected to grow roughly somewhere in the mid-teens, call it 14% over the next 3 years annualized. And considering the fact that this is a company that's now expecting to grow 17% in fiscal 2024, maybe if they can look to accelerate their growth back up to, call it 15, even 16% for fiscal 2025, yeah, that could help the case for having such a high price to earnings, at least for a little bit in the near future. So in terms of the results for this previous quarter, those came in line to slightly better. It's just the guide for the upcoming earnings in their Q4 that came in slightly lower. But consider the fact that you have full year revenues growing somewhere around 13%, when they were expected to grow at around 11% and then full year EPS growing closer to 17% instead of the expected 14%. So you really have to have a longer term, broader view in terms of Intuit. The other thing to note with this stock is you do get a dividend. You get a small 0.54% forward yield on shares of Intuit. That's roughly $3.60 in terms of a annualized forward dividend. And so while that dividend is small, the thing to like about this is that you have 12 consecutive years of dividend growth, and they're compounding at roughly 15% annualized over the last 12 years, at least over the last 5 years. And so you're looking at roughly doubling the dividends you're receiving every 5 years. And so that's something to like with Intuit. Despite the dividend being pretty small at the current time, if you hold the stock over really any 5 to 10 year time period, the dividend yield you get on your original shares look far better. And consider the fact that their payout ratio is still just close to 20%. This is a company with a long runway ahead of it in order to raise that dividend. In terms of their balance sheet, everything looking as expected. You have roughly $9.2 billion in terms of current assets. That's up significantly from just 9 months ago. This is a 9-month picture, considering this was their Q3, as 9 months ago you were sitting at roughly $5.5 billion in current assets. That's balanced out by roughly $6.1 billion in current liabilities. All things considered, this company does still have a decent amount of long-term debt, $5.9 billion more long-term debt than their cash. So from that perspective, not great, but consider the fact that this is a company with high gross margins of nearly 70%. And so they certainly don't have a ton of costs and expenses over at Intuit. And on top of that, they're spitting out just large amounts of free cash flow, as you have roughly $4.5 billion in operating cash flows. That's over 9 months. And consider the fact that you don't have a ton of capex, and so roughly $4.2 billion worth of that is free cash flow. And so when you have close to $5.9 billion in long-term debt, but generating roughly $4.2 billion in free cash flows over 9 months, yeah, that long-term debt, certainly nothing of concern over at Intuit. And like we said, not a ton of capex, just $200 million in the most recent 9 months. And so with that $4.2 billion in free cash flow, this is a company that does a little bit of a buyback to the tune of $1.7 billion, do pay out roughly $700 million in dividends, and add the rest on to their cash pile. From their financials, this is a company that's extremely predictable and really easy to understand. Not a whole lot goes on over at Intuit. Their Q3, certainly their strongest quarter, and the rest sort of fall in line with that mid to low teens growth rate. Now, from a chart perspective, you do have this roughly 6% drawdown in the after hours. And so if we dissect this uptrending channel somewhere in the middle of it, yeah, you're sitting smack dab in the midpoint for this channel. And so at this point, certainly wouldn't be overly excited to step into shares of Intuit, but if you're dying to get in at this point, you could look to open a position. I personally would be a little bit more patient with this name, allow it to come down to at least the lower end of this channel, sub $580 a share. That is the first point where I think you could look to step in, considering you're still in a well-defined uptrend, and this is a highly predictable name. Unless you break that level sub $580 a share, there's really no reason to think why shares of Intuit won't continue this uptrend, at least from a technical perspective. Now, if you do get a break underneath, call it this $580 level, yeah, your first level of support is sitting closer to $550, where your previous set of highs were. Even at this level, shares of Intuit still can be considered to be in an uptrend, although one not as steep as you currently have. Now, if you do have any significant downside with Intuit and you break underneath, call it this $500 level, and you break to the downside, your $480 level, that is where I would step in far, far more aggressively with shares of Intuit. Consider the fact that, yeah, you would have broken this steep of an uptrend, but you'll likely still make a less steep pattern of higher highs and higher lows. And once you come down sub $500, the forward price to earnings for this stock will come, in my opinion, likely underneath 35 times, closer to 30 times. And from a long-term perspective, that makes a lot of sense to pick up shares of Intuit closer to a 30 times earnings multiple instead of 40. So in my opinion, one, I think you can be a little bit more patient with if you are looking to step into shares of Intuit. The first level would be, call it closer to $580, where I would be certainly interested in picking up shares of Intuit is in this level, call it somewhere between $550 down to $480 a share. That was my take on shares of Intuit, a very predictable company, but one that is still trading at an expensive valuation, and one where I would wait for a deeper pullback. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.